Good morning, everyone. Welcome to this update for global stocks and commodities for the 12th of August. There's been obviously some nervousness in the market over the last few months around trade wars, around what Trump is doing. And in this last week, particularly on Thursday and Friday, we've seen some currency turmoil in Europe and specifically in Turkey. And that causes short-term disruptions to the market. But it's so important to step back from all that short-term noise and look at the things that are actually driving the market and look at what the market is actually doing, rather than falling into the trap of what the media is putting out. Because if you really stand back objectively, it's very hard to find good news stories in the media. It's mostly about what can go wrong, and even with the trade tariff situation, all the reporting is about all the negatives. There are actually some positives, negotiations being concluded, particularly with Canada and Mexico, between the US and those two countries. And yet that's not getting reported at all. So perspective is absolutely critical. We're almost to the end of the reporting season in America. And so it's very instructive to review what's gone on there. So I think you'll find a lot of valuable information in this particular update. So let's jump in and just have a look at how this market should be played. What are the facts, and how should most people approach this current market? We'll be looking at the normal stock and commodity trend updates. And last week in Portfolio Analyst, I got, again, some really good feedback. I did a spot on trading tactics. I looked at a bunch of Australian energy stocks and reviewed the strength and the opportunities in that sector, and also a local tech stock that has enormous potential. And I've introduced a couple, but members of Portfolio Analyst have also been putting forward some seriously exciting, albeit long-term propositions, but companies that have got technologies that can and will just revolutionise their particular industries. So I'm thoroughly enjoying doing Portfolio Analyst because I'm getting an opportunity to review stocks that I didn't know about, and have just got the potential for enormous futures. So the backdrop at the moment in America, the earnings, we've seen 91% of stocks in the S&P report so far. Those earnings growth has come through as forecast, perhaps even a little bit better than forecast, and 79% have beaten the market expectations and the company's guidance. Now, anyone that's been watching this video for more than a year or two knows that the US market reporting season, it's a game that gets played. The reporting or the guidance is relatively lowball. The companies beat it, everyone's happy, the share price goes up, and that's the way the game is played. But and most of the time, the companies are fairly conservative in their forward guidance. But over the last year or so, US companies have been raising their guidance at a rate higher than normal. In other words, the CEOs have been going out on a limb. And so there was the risk that they might fall short. But not only have they not fallen short, they're beating at almost an unprecedented rate. So it just shows you the earnings momentum in the States. And that earnings growth on a blended basis represents nearly 25% earnings growth. That is just extraordinary. And it's not like we're coming off a low base. Now, okay, the energy sector is, and that is having a bit of an impact. So the energy sector was coming off a low earnings base, and so it's posting some pretty big percentage numbers. But that's only one of 9 sectors in the States. So overall, we're looking at nearly 25% growth across the board. And certainly technology has been very strong, and healthcare has been very strong. So really an outstanding earnings season in America. It's delivered everything that I was looking for. The forward guidance continues to be robust, so the CEOs are not taking their foot off the pedal. They're continuing to to paint a very rosy picture. Now, the market breadth, again, the media trying to beat up a negative story is now making the point that the FANG stocks, Facebook, Apple, Alphabet, etc., are the ones that are leading the market. And look, there's no question that there is a positive feedback loop with the ETF market. So the money is going into the ETFs and going into the stocks, and one is propelling the other. And so there's no question that that's happening. And to a degree, the rises in some of these stocks is in the absence of a proper examination of value. But with the earnings growth as strong as it is, then it's not all a negative picture. So this is just something that I keep an eye on. It's not something to necessarily worry about at this stage. But if it continues at a higher rate, then obviously it will become an issue in the future. But for now, it's not. The general breadth is still very strong. So again, a lot of media reporting is saying that the indices are going up just because the FANG stocks are strong. That's just not true. The general breadth, the advanced decline line, has set a new high and has been set 3 successive new highs in the last 2 weeks. So there's no breakdown in the general breadth at all. From a valuation point of view, valuations look absolutely fine. The 2018 forward PE of 16.6 times is pretty close to the long-term averages. The reality is that big trends are driven by earnings. They're not driven by trade tariff disputes. They're not driven by currency upheavals in Europe. They're not driven by inverted yield curves or anticipation of an inverted yield curve. They're driven by earnings, and the rest is just noise. It affects the prices in the short term, but it doesn't derail the long-term trend. And for those of you that follow the market closely, just think about how many times the top has been called in the last 4 or 5 years. It's several times a year. There is some reason why the bull market has to stop. And some of them are just because it's old age, which is just, a crazy justification. So ignore all that. The earnings growth, this is the facts, the earnings growth has been so strong that the sector PE ratios have actually fallen since February. Now, the prices have gone up. And I look at some of the sector ETFs, some of the sector indices in America, and you'll see that they've been rising, and yet PE ratios are coming down. So, in other words, earnings are rising faster than prices, and that's a really good formula for sustaining a bull market. It's a really good formula for not having a market top. So, just ignore all that noise. Growth stocks is where you want to be. You don't want to be switching over, certainly in the US anyway. You don't want to be switching over to, to value stocks, to low growth stocks, to, stable protective stocks. High growth is where it's at. It's where you need to be. The only issue you've got to deal with is that higher growth stocks do have higher volatility. One goes with the other. So you've just got to get your game plan and get your perspective clear enough so that you can ride out that volatility that sometimes might disrupt your portfolio value for a few weeks or even for a few months, depending on what sector you're in. It's just part of the mix of what makes up the market. So that's the backdrop. Let's look at American stocks. The index fell 7 points across the week, which was only 0.1%, so pretty flat. There was a bit of a wobble on Friday, and that really that's what took the S&P down for the week as a whole. There is certainly a debt and currency issue in Turkey, and yet again the media rolls out, well, we're going to get contagion amongst European banks. But how many times have we heard that story? We heard it over Greece, we heard it over Cyprus, we heard it over Italy, we heard it over Brexit, and yet none of that contagion ever really manifested itself, and I don't think it's going to manifest itself again this time either. So we got a bit of a domino effect. the issues in Turkey caused the euro to fall, caused the US dollar to go up, which caused the Australian dollar to go down, and that all that nervousness fed through into stocks. But it was, I think, interesting on Friday to see that the US indices finished well off their lows. Most stocks finished off their lows. So it was only just a very short-term reaction. The indices are quite deceptive. If you look at the S&P and the Russell and indeed the Nasdaq, you'd be fooled into thinking that really it's all very calm and serene. It's not actually the case. If you look at it on a stock-to-stock basis, as I do over many, many hundreds of stocks, you see very significant moves, both positive and negative around earnings. I've seen plenty of 10 and 20% moves, both up and down, in a single session. In fact, in almost in an hour or two. So there are some extremely large moves, which means you've got to tread carefully. You really don't want to be trading ahead of earnings. Wait until the earnings are out of the way, and then you know what you're dealing with. Now, the US dollar was sharply higher for the week, as we'll see. We've clearly broken above consolidation, and that was due to a euro sell-off. So let's look at some charts. We'll start first of all with the S&P. Now, this is on a monthly chart, again, just to give you the big picture perspective. There's nothing in that chart that looks remotely like a top. So, you can just forget about that as a possible concern. This is the weekly chart, the daily chart. Here's our all-time highs up here at 28.72. And we've broken above the previous highs, the highs of March, and clearly we're still on trend. This dotted line through here is the trend that goes back throughout 2017, and we really haven't deviated from trend at all. If you extend that up, you find that we're right bang on the long-term trend that's been in place since the start of 2017. It's just got more volatile. And it just feels a lot worse than what it is. So that's the S&P. But as I said, this fairly mild performance at the index level certainly belies a lot of volatility underneath. Let's look at the Nasdaq. So this is the QQQ, where basically we've set new all-time highs during July. And we're only a tick off them at the moment. So still the very robust uptrend in the Nasdaq continues. And just to complete the picture, this is the Russell. Now the Russell has slowed down, so there's no question. But then the Russell had been leading. The Russell was stronger than any of the other indices, including the Nasdaq. So to go into a period of sideways reaccumulation, which is what this is, then that's perfectly normal. So not concerned by that. And if you look at the actual market breadth indicators, the advanced decline line and the various other indicators, the breadth is all good. So no issues there. Let's look at the big move in the US dollar. So we've been constrained in this little wedge zone here between, let's say, 94 and 95 and a bit, and a very robust breakout on Thursday and Friday, as you can see. Now, a lot of people are getting concerned about that we've had such a strong move in the US dollar from below 90. We're now at 96, and pointing out that, that's not sustainable, etc., etc. But again, let's just pan back and take a look at the big picture. So over here, just left of the middle of the chart, is basically the start of 2015. So if we look at the big picture from 2015, which is 3.5 years, then you see that the range is between, let's say, 89 and just over 100. And at the moment, we're sitting at 96, which is not far off the middle of the range. So, at a bigger, more relevant perspective, the rise in the US dollar is not an issue at all. It's only moved back into the middle of its 3.5 year range. So I don't see a problem with that at all, and there's no reason why the US dollar, this is now such a robust breakout that I think the likelihood is that this is going to continue higher, and it's going to push the Australian dollar down, which means that if you've got money in America, you're getting a free ride from the currency perspective. All right, just while I'm here, let's just look at the impact then on the Australian dollar. So the Aussie dollar has fallen from 81. We're now down, and we closed at 73. But you can see that of late we broke through a support level. We then consolidated under that support level, but now we appear to be breaking down on that level as well. So we've got next stop down here around 71, 72, and then we've got the lows of the recent decade down at 68, and you have to think that they're in play now, particularly as we broke support in the Australian dollar on Friday. So that's the picture around our currency. Let's look at the Australian ASX 200. The bank's coming back into favour a little bit, and that's helped sustain the ASX 200. But look, Australia's just so much a stock pickers market. I think generalisations in the Australian market are just a waste of time. The other thing that I was going to do is just to look at some of the US sectors. So this is XLK, which is the technology sector, and you can see what a tremendous trend technology has been. Look at the 200-day moving average, the red line. Stability is beautiful to watch, and we got a little bit of volatility in February, March, and people were anxious to call the top in technology. But again, it's just regathered its momentum, and it continues on up. And as I mentioned at the start, the technology sector earnings have been pretty much the strongest, along with healthcare. So there's no reason. And the actual PE ratio for the technology sector is actually contracted by 2 percentage points. So there's no reason why this technology juggernaut can't continue, and that's, I think, really where you need to keep your focus. Let's look at American banking. Haven't really got the momentum happening yet. We had a little look over the peaks through the week, pull back on Friday, which was really a result of what happened in Europe. But I'm really of the view that we're going to see banking start to progressively move higher. And just while I'm here, let's look at the US Energy Index. So again, it's looking fairly strong. It's unable to break through these recent highs. So we haven't broken out yet, but we've got a really nice consolidation happening beneath this overhead resistance, and I think it's probably just a matter of time before we do see a breakout in the energy sector. All right, so I've covered most of this. The Australian dollar actually went down below 73, and I'm looking at targets down at 71 and 69. The ASX 200 was up 43. It's really nothing different there. It's for me, it's a stock pickers market, almost exclusively outside of the top 50 stocks. I think that's where you've pretty much got to be in Australia. Gold was down $2, down to $12.12. Sentiment is horrid, and that sort of gets my contrarian antenna up. But that doesn't mean that it's ready to reverse. So wait for the reversal. I think one will come because sentiment can't remain this bad. It just doesn't work that way. So I think there will be some better days ahead in the gold sector, but do nothing until it does, unless of course you're in Australia, which is a different story. So we'll look at gold. We'll look at GDX to give you the global picture on gold stocks, and then we'll look at my favourite Australian gold stock that I've mentioned many times, and I've followed very, very closely for a long time, and they're doing just fine, and you'll see just what a substantial difference there is. So let's look first of all at, there's the gold price. Just pan it back a little bit. So we're heading now down. We're down at support at 1205. We've then got more support. So there's a cluster of support from 1205 down to 1185, and then after that you're sort of back to the 2016 lows down at 1130. So if we look at that on a weekly chart, you can see how we clearly broke the uptrend. So we had an uptrend in place there. We've clearly broken down from that, and there's absolutely no reason why gold can't continue lower in the short to medium term. But the more it goes, the more that the contrarian opportunity starts to build up. Let's look at GDX on a weekly chart. So GDX continuing to underperform. That just looks horrible. Here's the highs back in 2016. So you can see we're way below those highs. So that's the global picture, and that would certainly include an Australian stock like Newcrest Mining. That's one of the stocks that does contribute to GDX index. But let's look at the best gold stock in Australia, in my view, and perhaps the best gold stock in the world, and that's Northern Star Resources. It's at all-time highs. There's not many gold stocks that look like that. They're a tremendous producer. This is not a trend that's built on hype or over expectation. This is just built on tremendous results year after year after year. And with gold going down and Northern Star going up, I think that sort of speaks for itself. Let's move on to other commodities. Copper was just steadying a little at 278, but it's certainly been hit by the currency and also by the global economy concerns, which I think are overdone. Crude oil slipped back a little bit, not by much, and the oil price is holding up pretty well. It's forming quite a narrow range, as we'll see, and that's despite the strong US dollar. So, you would have thought that the oil price would have come off more on Friday with that big surge in oil, but that wasn't the case. And also, I note that crude oil and crude oil product inventories are below their 5-year averages. So, we're still in a position where the price of crude oil is not there because of speculation. It's there because of lower than normal inventory levels. So that's a good thing. There's the copper chart. As you can see, we've just been stuck there for a few weeks now. And again, we've got quite a narrow consolidation range here now between 67 and 70. And that's pretty impressive considering what the US dollar has done. And we actually ticked up on Friday night. So to wrap it all up, and I also want to show you a chart that I think you might find very instructive. The strongest message I can send is don't try and guess where the top is. That's what the media wants to do because that creates a great story. Don't do that in your own activities because it's just going to cost you money. Stay with what is until it stops being the case. And I've shown that exercise where I look at how much forward warning you would have got just by looking at a very, very simple approach to the market in 2000 and in 2008. Major market tops are so easy to spot 6 months in advance that you just need to stop worrying about that we might be at a top now. You'll get 6 months warning before a major top, I can assure you. As long as you just don't buy prices that have just gone up and are therefore overextended, you should be fine. Only buy pullbacks in strong trends or by the start of the markup in accumulation zones or reaccumulation zones. And I do a lot of this in Portfolio Analyst, and I just want to show an example of that because there's a lot of people who watch this video who have probably never had a look at Portfolio Analyst, and I just want to give you some insight into what goes on in that forum. So let's jump in and do that. All right, so I want to look at an Australian stock called Nearmap, which is an Australian technology stock that's done quite well. This is not a recommendation, of course. This is just looking purely at an example of a very textbook trade setup. So this is the outcome. So you can see we had a run up in price from around the 60 cent mark. We got up to $1.10, and then we formed a reaccumulation range, which is a pause in the ongoing trend to to let the market acclimatise, let the fundamentals of the company catch up. And we formed a trading range between 110 and call it 90 cents. And then we got a tremendous breakout, and we're now up trading around the $1.50 mark. Now, the trick here is to be able to get onto these sort of trends early. So, as I said earlier, in this sort of market, you either need to buy a dip in an ongoing uptrend, or you need to buy the latter stages of a reaccumulation zone or the start of the markup phase. So when the price is starting to make its move, when the big money is starting to really buy more and more of the stock. And there are many things, there are many indicators that you can find that give you that tip off, if you like. And as I said, I do a lot of this in Portfolio Analyst. So let's look at it, what it would have looked like in real time. So here's our move up to $1.10, and you can see the price got well ahead of itself up here at $1.10. It got way above the 50-day moving average, and you can see from these volumes we got a real buying crescendo. Now that almost always is the end of the move for the time being, and we then get either a top, a major top, and the price ends up back down here somewhere, or we get a sideways pause for a while, which I call a reaccumulation zone. Now, in the early stages, we don't know whether this is going to be deep and long, a reaccumulation, or whether it's going to be shallow and brief. But there are some tip-offs that we can look for. So we put a bit of structure around this. So we look for where the price initially stopped and then bounced. And then we look at where it bounces to. So we bounce up to here. So we start to put some structure around this that then becomes a bit of a guide. So you can see that we certainly got some increased volume off the peak, but that volume deteriorated very quickly. So that volume went away very quickly, which is an early sign that this is likely to be a shallower and briefer reaccumulation zone, and therefore that you can probably buy the bottom of that zone with some confidence if you get confirmation. Now, what happens during the early stages of reaccumulation zone is that various interests run the price up a bit to test how much selling is out there. So they run it up and they see what selling comes out of the woodwork, and then they just allow the price to sag back down again. And then they run it up again and they test the selling. Now you'll notice on this run down here, it looks fairly negative, but look at the volumes. Other than this one day here, the volumes were incredibly modest and certainly far lower than we saw over here. So there's the second sign that this was probably going to be brief and shallow. Also, the price failed to break these lows of the 5th of April. So there's a third sign that we're probably going to get a markup confirmation fairly soon. So we run up again, we come down again on very, very low volume, almost non-existent selling volume. The price just dribbles down. So let me advance it one frame at a time from here. So here's the first sign that maybe we're now to the markup phase. So we've got enough evidence down around here that this is likely to be brief and shallow. We're just looking now for confirmation. So there it is there on the 6th of June, and the price closed that day at 96. We move forward one day, we get a gap up, which is a sign of strength. We break above these previous highs, another sign of strength, and the volume is even higher. So really, really positive signs. Again, the next day, it's pretty evident that we've got a huge move on our hands here. It's just a matter of starting to take a position. It's probably been fairly difficult to take a position here because of the gap. Had this not gapped up, this would have been an appropriate time to start to accumulate a position. We ran up to the highs and then we pulled back. Now we're now looking for indications of some stability, whether this is going to pull back and test the breakout or whether in fact this is just going to go on with it from here. So on that day there, I'm now starting to see enough evidence that we've got a really good breakout on our hands, and so buying somewhere around about $1.05 would seem to be a pretty good opportunity. So we then get a few days of basically up and down, fairly brief, and then again we bust out on big volume and the trade's away. And so entry opportunity here, entry opportunity here. So we have confirmation through here. We've now got another confirmation through here, and then the trade just absolutely takes off. We come back, we do a little bit of a retest, and then we just absolutely blast away and end up where we are currently. So absolutely textbook example. The reason that I show that is because understanding how to get these sort of entries means that you're trading with a much higher probability and a much lower risk than the way that most people go about it. So that's what I do over and over and over again in Portfolio Analyst, and I think members, or I know members, get a great deal of value from that. Now, Portfolio Analyst this week, I'm going to be doing more on high probability setups. That's just an ongoing theme, and there's always lots of good opportunities get presented as well. So there's a free trial for anyone that hasn't taken advantage of that, and I'll look forward to doing that again this week. There's my contact details for any non-members of any of my various services, and I'll look forward to being back with you next weekend. Cheers.